Hi everyone, this is Michael and Michael. We are here to tell you a lot about mortgages and why you should get pre-approved and much more. So I'll start to say something about myself, and I've been a real estate agent for 5 years, sold over 300 homes, and very excited to help people to find the perfect place for them. And wanted to say thank you to the Wilden to let us to film this here. And now Michael, tell us something about yourself.
Hi, Michael Huber. Huber Mortgages. I've been a mortgage broker for about 8 years now. 7 years in this business, and then a year at a big bank. So I've got some varied experience, and I just wanted to thank Michael for inviting me on here to give first-time home buyers a little more information before you get into the process. So,
perfect. Well, thank you.
Yeah.
Thanks for your time. And first, we'll start with. Michael, tell us about why buyers, before they go in to search for the home, why they should get pre-approved, why they should talk to you first. What are the benefits?
Yeah, a few things. First of all, buyers are getting a little more keen to the idea of using a mortgage broker, and the Bank of Canada has stressed that this is an important thing to do. First-time home buyers use a mortgage broker about 50% of the time. So it's good. I mean, mortgage brokers are working full-time on mortgage files, and they get a really good sense of where they should place your file. So it's good to at least get a second opinion when you're going into the marketplace for the first time. I recently wrote a blog called Why do People Go to Realtors First? And it wasn't a slight at realtors, because they're fantastic people, but a lot of the time people will go to a realtor first, and then they'll go out and search for a property, and they won't know exactly how much they can afford, and what that results in is kind of a lot of stress once an offer is made. People really don't know what's going on, and so when people come to a mortgage broker first, what we can do is we can get a rate guaranteed first of all. Also go through your income documentation, your credit documentation, your down payment documentation, and get that all looked after before you even go out house shopping. Once you have a pre-approval and a lender commitment or not a lender commitment in hand, but a letter from me in hand saying that all of this work and due diligence has been done, you can go out there and shop confidently. Plus, it makes your offer stronger. If you can go in with a document that says from a mortgage broker that says, hey, you've got everything looked after and your credit's clean, all that sort of stuff, if you're in multiple offer situation, I think that you stand a better chance of having your proposal accepted.
Absolutely. Just to add to that, I think there's 3 big things when you have the approval in place. And number 1 would be that you can see all the houses that are listed, because sometimes that is being restricted. The sellers will say, I'm only going to allow the people that are pre-approved to see my property. Secondly, obviously, as you've mentioned, the offer could be a lot stronger because your time frame for the financing could be shorter, or sometimes you don't even have to have that in there if you have really, really good credit and you can set that up. And thirdly, it helps you to secure the best interest rates, right? You have the time to shop around, and that's probably leading question for you, Michael, is what's the difference going to the bank versus going to the mortgage broker? What's the benefit?
All right, that's a question. That's always the question you get right off the bat. What's your best rate? Now, with a mortgage broker, you can, I'm looking at mortgage companies, credit unions, and also the big banks. Now, when you're looking at those 3 different lending institutions, typically their rates are about the same, but the big differences happen in the terms and conditions of the contract. So that's sort of the next topic I did want to bring up, because it's really important for buyers to understand that lenders make a lot of money off of the interest, of course, but they also make even more money, I think, off of the mortgage penalties that they charge. In Canada, 65% of people with a 5-year mortgage end up paying a mortgage penalty. So you have to be aware of what's the best lender that you can go to, you're always going to have to pay some sort of penalty, but where can I go that if I do have to end my mortgage within that 5-year period, I'm not going to have to pay $10,000 or $15,000 or $20,000 in penalty. I'm going to pay something like maybe 2 or 3. And it's just in the difference in the way that one lender will calculate a penalty based on a standard calculation versus some numbers manipulation. And I don't need to get into all of that. It's just into the details because it's just boring numbers stuff. But there's very specific lenders that will provide you with a super interest rate, but also with a penalty that if you have to leave, it's going to cost you a few $1,000s, but it's not going to be too bad at that time.
And that led me to a story that I just had. I had a seller that didn't like the place where they were living, and it was a townhome, and they had high strata fees. They realized, hey, it's a little too much for us. We would like to buy something without the strata fees. And I said, look, go to, find out first what's your penalty. And it was over $13,000. And guess what? They were not able to sell it. They had to wait for another couple of years to be able to lower that penalty down. So definitely super important. And Michael, now you were mentioning some of the stuff about the interest rates. So I know the way they word it, it's always super confusing, right? It's like three and a half times of the interest rate, and it doesn't sound like it's a lot, but it could be a substantial amount, right?
Yeah, some people will. If you have a variable interest rate, you'll always pay a 3 months interest penalty. If you have a fixed mortgage rate, you could have a couple of different scenarios. One would be the interest penalty. One would be the interest rate differential penalty, and then one could be just a straight percentage. So some of these contracts will say, if you have to pay out before the end of 5 years, you're going to pay 3% of the outstanding amount. Well, in those sorts of situations, geez, you can be looking at an $18,000 or a $25,000 bill, and those are really predatory practices that unfortunately still exist in the Canadian market. You really have to be careful of that stuff.
Well, thank you so much for sharing that info. And Mike, we had also, I guess the next question would be, I had an experience where we were going through a traditional bank getting a mortgage, and they really gave us very harsh sort of condition because it was an investment property and they wanted to have a future lease for the property that we didn't even own. And I was like, this is ridiculous, we can't do all of this. So we went to that was a time when we went to a mortgage broker, and they looked at all kinds of, I guess, different options for us, and they found much better mortgage. So how is it possible that, or is there such a thing that, some people might be thinking, well, all the banks are the same, right? It doesn't really matter. But how come there's so many different options? And, I guess that's your job to find the best option for the buyer for that particular situation. So is there better banks, or tell me a little bit more about that?
Well, I don't like to pick on anyone too much, because in certain circumstances you need to use some of the bigger banks out there. However, from my experience, the bigger banks tend to have the most onerous prepayment penalties, and I think they can do that because there's only 6 of them out there. 5 of them, 6 of them, I don't know, I don't use them that much, but what they're able to do is, because they've got spots on the corner, they're recognizable institutions, and they're very well-run corporations. They make a lot of money for their shareholders, so people tend to go there because they feel like they have a relationship. When I propose working with, say, a mortgage company like an MCAP or a First National or CMLS or Street Capital, those sorts of institutions, they just provide mortgages. So they specialize in the mortgage industry. All their money comes from the same investment pool as the big banks. So you're dealing with the same, investors who want a certain amount of return from their investment into the mortgage market. But in those situations, they deal with a standard prepayment clause, very different from the banks. And they do that to provide themselves with a competitive advantage so that they can go into the market and sort of cut into the bank's business. And what I've seen with first-time homebuyers, they're especially sensitive to this, and that sort of shows, like, some of the older generations, they tend to stick with their banks. So about 35% of people who are not first-time homebuyers will be using their main bank. First-time homebuyers tend to be looking at sort of, what's my best deal? What's my best all-around deal that'll protect me, allow me to avoid penalties, and allow me to pay off my mortgage a little bit faster over the 25 years. That's
actually a perfect segue to the next topic. What's the best way to save money, and is it the best way to focus and pay off your mortgage first, or is it is it better to maybe invest the money somewhere else? I'm a big believer that it's a good, because it's a fairly large amount of debt that we have, and by paying that off, I think we can save a lot of money. So tell me, what's the best strategy for the first-time buyers or home buyers to save some money?
I wouldn't profess to be a financial planner, but I can tell you about some tips and strategies on how to get that mortgage down quicker, and really to save a lot of money. There are three main ways that you can do that. There's an accelerated payment option, which means that you make a payment once every 2 weeks. So you make 26 payments throughout the year, so it eventually amounts to an extra payment every year. You could up your regular payment by 20%, and you can also make a lump sum every year. So usually they call it a 20-20, so a 20% increase to the payment, 20% lump sum of the original amount of the mortgage per year.
Is that for every mortgage, or is that for
That's for the monoline mortgages.
Okay.
Usually but even with the banks, usually it's between 15 and 20%. So they're all pretty good. They've all got pretty good prepayment penalties, or prepayment privileges rather. But for example, if you had a house that was, it doesn't really matter the amount, but if you use that 20% payment increase, you'd pay your mortgage off 5 years sooner. And say it was a $450,000 house, you'd save about $55,000 in interest just by doing that. So you make that little increase to your payment. That increase goes directly to the principal, hacks 5 years off your mortgage, and saves you, upwards of $50,000.
That's incredible. We've done that with our first home, and we were able to pay off. We then sold it, bought some investments, but we were almost able to pay it off in 10 years. But the amount was not as big as you get now, right? So, we save a ton of money. I think it's important for people to know how to do that. So I guess another option, and maybe tell us, if you're getting into, or I've been asked a lot lately that, is it a good option to have a rental suite? How does it work with the mortgage? Can we get a tenant and use that as an income if there's a lease in place? And maybe give us more information about that.
Yeah. In our market in the Okanagan, it's a fairly standard practice to see homes with the rental suites, and the government is fairly encouraging. The local government's fairly encouraging of that around here. As far as the mortgage goes, if you have a tenant in place, it can mean the difference between maybe a condo and being able to get into a single family home. Because if you have a lease in place, or we can use market rents in your mortgage calculation, what we'll be able to do is use that rent and probably increase the purchase value by about $50,000. You have to be aware of the rental regulations, because that's sort of the number one that I always say to people is, it's nice to get money coming in, but you really have to know what your rights are as a landlord, and you have to know what your tenants' rights are, so you don't get into any trouble during the rental process. But if you can get that up front, it can really be helpful, because if you're getting $1,500 a month, that's going to, you could use it to, decrease your housing costs, but you could also do something like splitting it up, building a home maintenance fund, adding that 20% onto the mortgage to pay down, and then take the remainder and stick it into an investment. So that $1,500 can go a long way, especially over 20 or 25 years.
I think it's a great option, and but there's people that don't want to deal with the tenant. There's lots of new regulations with that, and it's a little bit more complicated. You can always get a property manager that will help you to find a suitable tenant, and to help you with all the legal stuff with that. So now maybe we could talk about the down payments and what kind of options we have, and what is the minimum, and maybe talk about were you thinking of making an investment. And
well, there's sort of two things that people seem to be as the market's kind of gone up in Canada, and I've seen a lot of more people come forward with needing a co-signer and needing maybe a little bit of down payment help from family or friends. The co-signer option, your co-signer just really needs to know that they're on the hook for the mortgage just as much as you are. They're not just signing there, willy-nilly. It's a very important decision to make, because it's part of their credit life then going forward. The down payment is another thing. You can get your down payment from a number of different sources. You just have to prove 90 days of its sort of existence. So bank account statements, TFSAs, RRSPs, your savings account, your checking account, TFSAs, RRSPs, investments can all be used for these, for your first time down payment. Also, say if you sold a vehicle or a piece of equipment and you had a receipt for it showing that money had hit your account, that would be a possibility. I've used those in the past. A friend had sold an engine to his brother, and so he had a receipt, and I was able to go, okay, that's where this money came from. We satisfied the requirements of the bank. And then obviously a gift from your family members. It has to be a close family member, parents, grandparents, aunts, uncles, that sort of thing, are able to provide you with a down payment. They just sign a gift letter, and we show that money came into the account from them, and that sort of looks after that requirement. Now, I think we're planning on doing this podcast hopefully on a fairly regular basis, just to keep people updated with stuff. So what we're going to talk about in a future podcast is this new government down payment program, and we'll give you the details on that. Won't get into that right now, because there's a lot to it, and we'll get into more specifics next time around. But I don't know. That's about all.
Yeah. So we just maybe do a quick summary. So if you're thinking of buying a new home, so definitely get pre-approved, because there's many benefits to it, as we've discussed. So the pre-approval is fairly easy process. Don't forget to ask about the penalties and how to set it up right in the beginning, so you can pay it off fast and you can save some money. Definitely look into, if you're brave, into having a rental suite, and if you're looking for down payment, again, Michael talked about the requirements, and I think that just to add to that, if you're buying a home and you make the offer, you've been pre-approved, it's not a good idea to buy a new truck. You gotta wait until everything is complete. I've had that happen once. That's a good one. As soon as you get approved, you can't go buying a whole bunch of furniture.
That's right.
And so you gotta wait until the house.
That has happened to me too. It's a disaster.
So I always mention that to the buyers. You gotta wait until everything is done and closed, and you get the keys. Then you can go buy a new truck. So thank you so much, Michael. It was a real pleasure to have you here, and we'll look forward to the next one, where we're going to talk about the government program that is going to benefit the first-time buyers. So thanks so much.
All right. Thank you.